today what we'd like to do is discuss per diem pay. Per diem pay is a way that you can receive an amount from the company tax-free. The current rate that the IRS has set is $63 a day. So that's the amount that we can reimburse you with per diem pay. It's to reimburse you for your expenses while you're over the road. So those things like your meals, drinks, showers, all the things that you know cost you a lot of money while you're traveling. It's not inexpensive to live out of truck stops. I know you all know that firsthand. They don't seem to ever have much that's a good deal. Everything is fairly expensive, and it's hard for you to get too far off the freeway, and so you end up paying those expensive prices for all the things that you need to sustain yourself. The advantage of per diem pay is it's free of taxes, so you don't pay any federal, state, Social Security, Medicare, Medicaid taxes on any of that, so you receive all of that money tax-free. The thing that's really changed as of 2018 is you can't take it on your own any longer. Previously, you could do it on your own. You could deduct those expenses on your own taxes using 2106. If you were itemizing, it allowed you to deduct all those expenses using your logs, to receive that money tax-free. You can't do that any longer. So what's changed now is the company is offering you a per diem. So what happens in per diem pay is essentially we take your rate and we divide it up and make a portion of it per diem pay and make a portion of it wage. In this example, 16 cents would be used for per diem, 24 cents would be used for wage. So that allows you to receive some of that money tax-free. You have a question?
Your first screen said it's $63 a day.
Yes.
Today I only put in 200 miles. So
yeah.
You give me $65 or 16 cents per mile?
That's a great question. So what happens is we take all of the data from CFI over the course of a year, and we look at how many nights each group is out. And then we use that information to come to a mileage rate. The IRS stipulates that we have to pay it by the mile. We have to pay it the same way it was paid in December 31st, 1989. Yep. That's the rule. And so we have to pay it by the mile. Who knows why? That's just their crazy rule. Again, another crazy.
That's not one of those pages.
Yeah, exactly. So we have to pay you by the mile. So we try to figure out how many nights out do we think you'll have. We divide it by the mileage that we can see that you've had over the last year, and then we pay it to you by the mile. So a day that you have very few miles, you might not get very much, but a day that you get more miles, you actually might get more. So we hope over the course of the year that we average $63. That's the plan. So it's going to fluctuate though as you drive, and that's going to be a little hard to see at times, because sometimes it's going to feel like it's a little much, and sometimes it's going to feel like it's not enough. But you just have to look at it on the average.
So is it based on a percentage?
Yeah, so it is based on a percentage. The IRS regulations stipulate how much we can pay over that amount, over the $63, without getting in trouble. So we use all those percentages to try to figure that out, and our objective is to pay you as a driver as much as we can and not get the company in trouble. So we're trying to balance that all the time of the more we can pay you, the better it is for everybody. But if we overpay, we put the company in jeopardy. So we're trying to balance that and trying to find that rate that really works.
So if the company goes over that $63 a day, then the IRS can come back and fine the company for going over that $63 a day.
Is it the company they would come for, or is it the driver, the person that they're
paying? The company has the responsibility to substantiate. That's the word the IRS uses.
Right.
To substantiate those expenses or those reimbursements. The driver has no responsibility any longer. So previously, if you were keeping your logs and you were keeping receipts and all those crazy things you had to do to receive this,
then the IRS could have come back on us and not the company.
They could if you were deducting it on your own. You don't have to do that any longer. You don't have to keep any logs for your records. You don't have to keep any receipts. All of that is a moot point now. You don't have to worry about that. So that's one real nice thing from a driver's perspective.
Less paper.
Yeah, less paper, less paper. I've met with drivers all over the country, and I've met with a lot of them who'd carry in a box of receipts, and I'm like, oh, that looks like it's such a pain, and I'm sure it's difficult.
Love it.
Yeah, so So you don't have to do that any longer. You don't have to worry about any of the receipts. The company is responsible for the substantiation. They do that.
Right.
So if they overpay you, it's their problem, not yours.
Right.
You won't have any obligation to back any of that up any longer. Like I mentioned, we looked at all of the information. We gathered a year's worth of data. We processed it. We tried to figure out what the per diem rate's going to be for each group. Remember, it's based on nights out and miles, and those vary by each group. And so we look at all of that from a year. We figure out what the rate's going to be, and then we plug it all back in just to make sure our models work and that it's true. And so after we do all of that, this is what the rates look like. It varies from about 14.5 to 16 cents. And you might look at that and quickly say, well, wait, why is OTR less when I'm out more nights? Well, the quick answer to that is because they have more miles. And if you're paying them by the mile, then the more miles you have, the more you got paid, and so that's why it's a little lower. But remember, the objective really is to pay you $63 per day for every day you're out. So even though these rates look like they vary a little bit, it's really calculated to be fair to the number of nights that you have out. So in the end, OTR should get, you know, the same amount as RSE, because we're trying to reimburse you that $63. So that's how the rates broke out. That's how they work. Team drivers, you split the rate just like you do with everything else. So if it's a 16 cent, if it's the regional RMW rate, it's 8 cents per driver. That's how you work that out. Who cannot participate? You can't participate if you're local, if you're slip seat, if you're an independent contract, if you're hourly, if you're a student or a driver that's required to work with a finisher. So you basically have to work for the company, you have to be out overnight, and that's the rules. That's kind of how it works.
That's the way it worked with the per diem before.
Yeah.
It
Yep,
always
exactly.
been.
So that's, those rules didn't change.
Right.
Those rules stayed the same, you know, like they've always been for 20 years now. So, any questions on any of that before we go to the next slide? Okay, perfect. So, obviously the quick question is, how much am I going to save, right? That's what really amounts to. That's what matters to you, is what's it going to save me? And what we've done is we put together a website. It's hchta.com/per diem. You're welcome to go to it, plug your individual information into it, and see exactly how it impacts you and what it'll do for you. Your password or your login is Drive CFI, all lowercase. So Drive CFI will get you onto that. So what we thought we would do really quick is just go through a few quick examples to show you the difference in pay if we shift those things around a little bit, just so you can kind of see how it works. Tommy's going to run it here, but you can see this is when you sign in, this is what it looks like. And basically what this tool is it's TurboTax. It's our version, we build it, but it'll run your federal taxes, your state taxes, no matter what state you live in, and it will give you your yearly income, based on your yearly income, your yearly take home. So it will show you all of that, it'll take all that information, whatever, you know, what we plug into it, and it will spit out what it means to you. We don't want to give you tax advice, because here's what's happening. We are just looking at a few things. We're just looking at your information as far as CFI knows it. We know that you may have a spouse who works, you may have a side business, you may have additional income from somewhere else. This is not considering any of that. This is only considering your employment with CFI and the wage you're receiving from CFI. The rest of that is not included in this calculation. So it's just a way for you to look at what it does for this piece of your income, not for your full income. So we would encourage you, you know, once you've looked at it, you can even take this tool to your tax accountant, and when you sit down to do your taxes, if you want to pull it up and say, hey, look at it, see what you think, you know, and put more of your information in it, you're fine to do that if you'd like to. So let's use the same information we were looking at in that example. We'll do 100,000 miles. The current rate is 40 cents. Per diem is going to be 16 cents. It says haircut up there. I don't know if any of you have worked for a company who's offered per diem who required you to give something back to be on per diem. That's what we call a haircut. And so some companies require you to give a 1 to 3 cents back to participate per diem. Most of them do. And have you had that experience? 3 cents? Yep. So that's what, and you probably heard him call that the haircut. So that's where that comes from. But in CFI's situation, there's not a haircut, so it's 0.
Thank you, Lord.
And then the state will just choose Missouri, since we're here. And let's do married and 2 children. This is going to be the top of the scale. This is going to be the person who saves the most. And then we'll do a single with no children too. But we'll start at the top, and then we'll do the person who saves the least. How's that? This is a disclaimer that basically says this is not tax advice to you. You know, we're just trying to give you an example of what it looks like with the information we have. So yes, I agree. And move on. So this driver saves $6,674 by accepting per diem pay from the company. So you can see that the savings is significant. What happens is, when you're looking at it, on the right side is what the numbers look like without per diem. So if you had just received all that money in wage. On the left side, this is what it looks like if you have per diem. So this is per diem, non-per diem. The crazy thing about this is you can look here. This driver takes home $43,037. They actually only made $40,000. But because of that doubling of the standard deduction, because of the $16,000 they received in per diem pay, and because of earned income credit, they actually get a bonus of $3,000 from the government for having a job, basically. This is what happens. They just they say, hey, this is working, we're going to give you earned income credit. So you actually end up with $43,000 take home on a $40,000 salary. You can see here, without per diem, that driver who made $40,000 would take home $36,000. So that's over the course of a year. That's over 12 months. So that $6,600 savings is over 12 months. So you can see that really the big difference is right here.
Yeah.
The $16,000 they're receiving in per diem pay with no tax. When you throw that in the mix, it's the only difference in the 2 sides. The bottom number looks like this versus that. So it's a bunch of money. It's essentially, this guy is getting an extra 6.5 cents per mile take home. We're not even talking about 6.5 cents per mile before tax. 6.5 right into his pocket. That's take home money difference in those 2 examples.
How does that affect your Social Security?
That's a great question, and we're going to talk about that. It's coming. So give me 1 minute, but don't forget that, because we want to address Social Security, we want to address loans, and we want to address what it costs to do the program. So that's coming. That's a great question. I'm glad you asked. Before we move off this, though, I just want to show you what it looks like on the single guy, no kids. Because this is the other end of this. So this is the guy who will save the least amount on the program.
Yeah, no joke.
Yeah, so
What about those who are married with no kids?
married with no kids. Yeah, we can do any of them. Let's look at this one, because this is as low as it gets. So here, same thing, 100,000 miles, 40 cents, single, no kids. That person saves $3,600. So it's still a 3.5 cent raise.
Yeah. Still
Per
say
mile.
something.
Yeah, so it's still pretty significant. And these numbers have really increased. They've got a lot better in 2018. This story would have been different 6 months ago. But because of the doubling of the standard deduction and the company still being able to pay you that per diem pay, that's where that savings really adds up. So this year it got much better.
Used to only be like most places, 6 to 8%. So
Yep, exactly.
That's the way it's been for years. I've had it 2 or 3 times.
Yeah, that's a great point. What happened is, we rolled a lot of those programs out, to be frank with you. In 2000, when the per diem rate was $38, it was only 65% deductible. And so they started paying it 6 to 8 cents per mile. It was really low. And a lot of them never adjusted that. So it's still at 6 or 8 cents when they could be paying 16 cents. Yeah. So you can see it's a big difference. I mean, if we paid this at 8 cents or 6 cents, this savings would be $1,200 instead of $3,600. So that's one of the advantages of the CFI plan. It's up to date, It's, you know, the rates are real, they're what they are today, it meets all of the code that we have out there, and really allows you to save a bunch of money. So, before we get too far into this tool, maybe at the end, if we have time, we'll go back to it. But that kind of, I just wanted to show you the two ends, the highest and the lowest, so you can kind of see. And you probably all fall somewhere in the middle of that, or somewhere, you know, in between. But let's go to the next slides and talk about some of these other things, and then if you would like, we can cover some of that other stuff. So the questions. So what's it going to cost? What is the per diem plan going to cost? What will it cost to participate in the CFI plan? The discussion now is that it will cost $14.90 per paycheck to participate.
So that's your haircut.
That's your haircut. You're right on. So $14.90 times 52 is $775 a year. That's what it'll cost you to save the $6,000 or the $3,000 or whatever you're saving. It equates to be less than 1 cent per mile. So you can see if a company that was charging 2 or 3 cents like yours, 3 cents at 100,000 miles, on that plan you paid $3,000 to participate.
Wow.
On this plan you pay $775.
Why am I paying to participate?
I love that question because that's where we're headed. That's the next question. So let's go through. Let's get to that. So why should it cost the driver anything? It costs the company something to run the program. You know, clearly when they have all their internal employees doing all of that accounting that has to take place. They have to pay for that.
Gotta hire somebody.
Yeah, they gotta hire somebody. And you're pointing at us. Yes, they have to hire somebody like us. So that's one of the expenses. The other expense is that per diem is only 80% deductible. And it was the same way for individuals or companies prior to this year. So that you had that same hit on an individual's taxes. So what that really means is, if I pay you as a company $1,000 in wage, I don't pay any taxes on that. I just pay you $1,000 and we move on. When I pay you $1,000 in per diem pay, it's only 80% deductible, which means only 80% of that is not taxable, meaning 20% of it is taxable. So if I pay you a per diem of $1,000, I have to pay taxes on $200 as the company to make that happen. So there's additional costs for a company to do that. So if there, you know, all things being equal, if there's no, you know, if there's no cost from the company, it's going to cost the company to do it, and it'll raise their you know, their expenses, and then they have to decide if it's worth it or not.
Is that $15 a week flat, regardless if I did 100 miles this week or 3,000 miles?
It's flat, and that's a great question, because with most companies, they do it by the mile, so they ask you to give up that haircut. And so if you're a high producer, you really get out there and work, you're kind of penalizing yourself, because the more miles you run, the more you pay to participate, where this one's flat. Flat and a nominal fee compared to what most of them are charging.
So the 20% is deductible for the company, but not for the drivers.
That's right. So
Okay.
the driver can't do anything any longer, so none of it's deductible to the
Okay.
driver.
Okay.
And on the company side, only 20% of it is.
So, a driver like me,
Uh-huh.
I dread all the paperwork. So I'm not itemizing, and I wasn't deducting, so I was never doing that before.
Okay.
Right? So now what you're saying to me is like, hey, I can save you $16,000 a year, but it's going to cost you $15 out of every paycheck.
That's correct.
Why should I do it if I've never seen the difference? Like, so I never did the deductions at all anyway.
Yeah.
So what I'm making now will be the same thing as if I don't do this program. Same thing. Why should I give?
Well, if you want to increase your take home, that's why. Because if you don't do it, you're just going to pay those extra federal, state, and FICA taxes. And, you know, that's your own decision. If you'd rather pay the taxes than get it on your own, that's okay. I mean, and the nice thing about CFI's plan is it's going to be optional, so we're not going to force anybody to do it. We're just trying to treat this as a benefit. So just like your health insurance, your time off, and all those things is another benefit that's available. If you say, hey, I've never done it, I don't like it, I don't want to do it, perfect.
So then that is my question. So if I don't participate in this program, nothing changes.
Nothing changes. Carry on, just like before.
Just give the federal government more money.
You just give the I didn't want to say it, but since she already said it, you just give the federal government
I
more
don't wanna
money.
give them nothing.
If you want to pay some extra taxes, if you're like, hey, this is all good and I want to pay a little more than I need to, that's okay. I mean, it's your choice. So it's an optional plan. You have to opt in. We're not even, most companies do an opt out, so they put everybody on unless you say, hey, you know, I want out. That's how most companies do it. CFI said, we're not going to force anybody. We're going to have you opt in if you want to participate. So you're going to have to tell us, hey, I want the extra money. It's sitting there. All I have to do is sign one document. I'm in.
In a roundabout way, that helps the company also, because they ain't got to match it.
Sure, you're exactly right.
I know.
You got it.
I've been there.
So
So now, if
So,
we're,
let me tell you his story really quick, because that's a really good point, and I want to make sure we cover that, is you asked, what are the advantages to the company? And the advantages to the company are, if they pay a driver $1,000 in wage, they have to pay Social Security on it. If they pay $1,000 in per diem, they don't, and it's 7.5%. So if they pay per diem, that's where they get to save a little. The challenge for them is then they have the liability, they have the non-deductible piece, and they have the administration of it. So there are still some pieces that they have to take care of.
so if we take like a week off, or 10 days, say 10 days off, we have no money on that week, all right? If we have $14.90 coming out, will they deduct that like they do now with the insurance and taxes and all that when we come back and have a paycheck?
That's a
No.
good question.
I can answer that question. If you don't have miles in your pay period,
Right.
that payout, you will not get the fee.
Okay.
And
Only
if I got
if you
one
have
day,
miles and there's some administrative that has to happen to
So it
break
won't
those
double
miles
up
out.
for nothing.
We're not gonna throw you in the hole and have to pay, you know, the deficits and get you caught back
Because
up.
so now, if say we
Get
take
your Social
10 days
Security
off,
question. It's
they
next.
double our insurance, they double our
Yeah, that's
deductibles,
one thing
our
concerned me.
501.
They won't do that.
We will not do that to you.
Okay. That's what I need to know.
I'll tell
if
you.
you're going home for
Yeah.
a week, you wanna go home.
All
for a
right,
whole
we got
week.
your question answered?
Yes.
So we're not going to charge you if you're on vacation.
Right.
Okay.
I like my 60 days a year at home.
These are the things we've already talked about, why they charge. Next question is, well, before we get to Social Security, let's hit this one really quick, because there's another question that comes up. What about loans? Because when I go in to get a loan for a home or a car, truck, any of those type of things, there have been times where if I was being paid per diem, it made it a little more difficult because they would just consider my wage to figure out how much I qualify for. Well, it's getting better. Before the recession, everybody included everything. After the housing meltdown, they were like, no, only wage, we're not going to consider your per diem pay in that calculation. It's starting to swing back. Most of the large institutions, the large banks will consider it again.
I know they did ours in
Yeah,
2008.
they do again. So if you're talking to a small local credit union, there's a good chance that they'll probably say no. So as far as loans go, you just got to look around. You'll still get people who will qualify all of it, but not everybody will.
Yeah.
So I'm glad that story's changing a little bit. If we, 3-4 years ago, it was like, it's getting, it's hard to find those companies, but they're coming around.
They're there.
Yeah, they're there.
You just have to dig for them.
Just gotta look, you're right. So, and then obviously, if you decided that you didn't want to participate because of that reason, just remember what it's costing you. So you're giving up all of those savings. If you're a married guy with 2 children, you'd be giving up $6,000 a year. So you don't probably want to give that up for too many years while you wait to get a loan. So, here we go, Social Security. So this is the topic that comes up all the time because being paid a per diem will affect your Social Security. You only receive Social Security benefits on what you pay in on. And when you receive per diem pay, the company nor you are paying on that portion. So it will reduce your Social Security. However, Social Security is based on your highest 35 earning years. So whatever, you look at your whole working career, your 35 highest years are what they base your Social Security on. So if you're nearing the end of your career and you're driving for 5 or 3, 4 more years, it's really hard to start to swing that average because you're working off a 35-year average, so it's hard to move it. A lot of people believe that Social Security is based on your last, I've heard quite often, my last 5 years of employment.
What I always.
Yeah, that's what I've always heard too. It's not the way it really works, so just make sure if this is a real concern to you that you do your homework, make a decision that works best for you. I mean, if you think about it, if you were saving $4,000 a year for those last 3 or 4 years you were working, I promise your Social Security won't be reduced that much. You'd be much better off to take that extra savings.
Any idea how much?
Yeah, we've messed around with it a lot. I'll give you some rough numbers. Yeah, let's just say for the last 5 years of your employment, you were receiving a $16,000 per diem. I think you could expect that to affect your Social Security payment on a monthly basis somewhere around $10.
Wow.
It's not
10,
that much.
12.
Yeah, so you'd be giving up $4,000 if that's where you fit into this model today to get, an extra $480.
Sounds pretty
At
good now.
retirement.
I know years ago it wasn't gonna be
Yeah,
that way.
yeah, exactly. So the other thing is if you're a driver who's going to drive for 35 years, you're starting fresh, you're going to get per diem the entire time, it's not going to be $12, it's going to be a lot more. It's going to really affect what you receive in Social Security. So what we tell those drivers is, it takes about half of your savings to break even again, to get yourself back to whole on the Social Security or retirement side. So if you were back to that example of $4,000, you would have to save 2 of that, but you'd still have the benefit of the extra 2 that you're saving, that you're getting back, to do what you'd like with it. But if you invest half of it at retirement, you're still better off.
But that still gives you an option of investing it yourself.
Wherever you want.
And get more money out of it than the Social Security is allowed.
You should be teaching this class. You're right on. You're right on.
You're done there, no thanks.
Yeah, experience, right? That's what you get with experience. So you're right on. Yeah, if you take the extra money on a yearly basis, that money's yours. That's the nice thing. Social Security, who knows? And you all know what it takes to get it out and when you get it and all of those things.
If you get it.
If you get it, she has got all the right ones. And if you take it and invest it and you decide, hey, I really need this money to buy a house or whatever, it's your money, you can do what you want with it. So that's how it works with Social Security. How is this plan different? How's the CFI plan different than other companies? Primarily the difference is we have a fee each week instead of a haircut. The fee is less. I mean, clearly, if you pay $14.90 a week, you're at $775 a year. If you pay 1 cent to 3 cents, you're somewhere between $1,000 and $3,000, and that's pretty normal. The other thing about the current plan is it's lower cost. We have more savings per driver, and the reason we have more savings per driver is because it's all up to date. We're using all the latest information to do your rates. This is all the things we've just talked about. Lower cost, more savings, correct calculations. It's an optional plan. We're not going to force anybody to do it. We understand.
Is there a cost to opt out of it?
No cost to opt out. And we understand, and really it's opt in. So if you don't want to do anything, nothing changes. You don't have toning, nothing. So we understand that not all programs work for everybody. It might not work for some people, and if it doesn't work for you, we just want to provide a benefit to the drivers that's available. If you look at it and say, hey, it's better for me, we want you to have that option. We know that there was a team who talked with Donovan's group yesterday who said, hey, we really want per diem. We're at our tax accountants this week. We can't take it on our own next year. We just found out we need CFI to do something. For those people, here's the something. Here's what we're going to do for you.
You showed on that one page where it's a single person, no kids.
Uh-huh.
It was like $1,400. Would
It was
that?
36.
$3,600 for those guys.
Okay,
So $3,600 minus the $775, that's about what you would you'd make an extra 1,800.
3,600 minus the 800 for the cost.
Yeah, exactly, so you're
Now
about,
you're at 2,400.
On top of what you would've got back.
Would that single person be better off to just put that amount into a 401k every year?
yeah, it'd be great if they wanted to do that, yep. Yep, if they wanted to take that savings and
That's
invest
a
it,
non-taxable.
but they'd have to be part of the per diem to get that, but if they wanted to take advantage of all ways to get out of as much tax as they could, if they were being very strategic, you know, tax-wise, they'd take full advantage of per diem, they'd take full advantage of 401k.
And
That would-
Roth IRA.
Yeah, and your
It's all-
Roth,
It's all non-tax,
yeah,
before tax.
if you were really trying to reduce your marginal tax rate as much as you can, which, you know, obviously is the best way to do it, and we all face the same challenge, can I afford to do all those things? But obviously that's the optimal thing. If you can make that work, that's a great plan. So,
Which that kinda helps, depending on which tax bracket you're in, you know.
that's right. And that's why those vary a little bit, is based on the tax brackets. So what the timeline looks like is, we're obviously doing training today, did a little yesterday. We're hoping to start talking to drivers maybe in the next week or so. We're hoping that if all things go well and we get some feedback from you and it looks like it's going to work, our plan is to try to roll it out mid-May. The challenge is, the longer we wait, the more money you lose if you want to participate. There's no way for you to get that money back. So as we keep delaying it, you know, pushing it out, trying to implement it, it costs all of you money. So we're trying to do it as quickly as we can.
Is there just one opt-in date, or if I take it home and I mull it over and decide not to
That's a
by
great,
April 23rd, can I
Yeah.
do it whenever?
that's a great question. And the answer to that is yes, you can opt in at any time. We would prefer you to opt out during our open enrollment period, because obviously the administration time to get people in and out is difficult. And then obviously on your side, we don't want a driver was on and off and on and off. And so we're going to let you opt in anytime, but we would prefer you to opt out during open enrollment periods. So,
if I opt in,
you're ready?
Yeah.
so if I opt in and then change my mind about it, hey, I don't want to do this anymore, now I have to wait until the next enrollment time to opt out?
Yeah.
Just like if you want to opt out of your insurance.
It's just
Yeah,
like
it's-
your insurance.
Yeah,
It's set up
same
just like your
as-
insurance.
401k and all those things. So we
Yeah.
try to treat it the same way. It's a benefit just like all of those. So we try to roll it out the same way.
I'm ready to sign my paper
It-
now.
It's a, there is a cost. We don't want to hide that. There is an impact on your Social Security. However, all the world's aligned really well for drivers with the new tax code. They
You're
allow,
not gonna get any money
yeah, you
back
can,
this year doing it yourself.
yeah, you can do it
So
on
you
your
might
own.
as well take this opportunity to get it now,
Exactly.
and, because you're not gonna get it at the end of the year.
Either get it or don't do it.
Yeah, you either get it or you don't. You can't, and you can't go back. Every day that passes, you
And I don't wanna
Are
have
committed to
one
pay
cent
that
more and
tax.
I have to get, that's for sure.
I agree. So, any other questions?